Dave, it's great to see you. And I think the thing that's most important to emphasize is that the turmoil you see all stems from the fact that you see them as kind of backed into a corner and having to tighten. They can't just back away, or maybe that's changed.
No, I don't know what I would say having to tighten, Kelly, but I think, the Fed that we know and love from many other periods where there was turmoil in the markets, whether it was the Chinese devaluation in 2015 or whether it was the COVID crisis in March of 2020. This is not a Fed that is undershooting its inflation target anymore and has plenty of room to expand its balance sheet, cut rates in times of stress. It just doesn't have that. And they're fighting a 7.5% inflation rate. They're going to have to be seen as doing something about it. And it's going to mean that their pivot toward help for the markets just comes at a very different place than it has in the past.
They would obviously back off if they saw a real risk to the U.S. growth picture. A lot of people have noted that the Goldman Financial Conditions Index is back near some of the recent tightness that we've seen that accompanies a weaker economy. How important is the tightness in financial conditions that we've seen?
So Kelly, I think the Fed is going to probably focus a little less on the equity markets, which may, be unfortunate to some of the listeners out there. But I think the credit markets will really get the Fed's attention. If the high yield debt markets freeze up, if the IG of stress, if new issues can't be brought, if deals get hung, these are the things that are going to really, catch the Fed's eye and probably give us more comforting words at upcoming meetings and testimonies than the words that are likely to be there at the current state of the market. And I think, that's why in the short term, I'm still quite nervous about how the Fed adds to this difficult period because of where we stand on the inflation side, which, Kelly, I still maintain are largely supply-driven issues, but the Fed just can't afford to let these inflationary expectations that are only short run. They're not in the really long run expectations. They can't afford to let them get into the long run expectations.
And what does it mean to you that we've seen real rates collapse back towards negative 1%? We've seen inflation break evens on a 5, even a 10-year basis, kind of moving out to new highs. What does all that tell you?
That's a risk-off move. Low real rates are sort of a flight to, hey, I'll take a negative 1% real yield for 10 years now, not 60 bips anymore, because, my alternative is being in the stock market or being in places that are going through turmoil. So it's really a sign of risk off. The fact that the break evens are going up in the front end is more of a sign of the temporary dislocation in the commodity markets. If you look at the 5-year forward, 5-year break even inflations, Kelly, and I know that's, kind of a bond geeky stuff to throw at everybody, but it's something the Fed does look at. So you should think about it. It's where the market expects inflation to be in 5 years' time. And you can trade that in inflation swaps or through the TIPS market. It really hasn't budged. It's still just above 2%, and it's been there for the better part of a year. So the inflation expectations are not dislodged now, and the Fed wants to make sure that stays the case. And I think that's why why Jay has had to be a little more hawkish than people thought he might be.
Shepard Smith here. Thanks for watching CNBC on YouTube.